Geopolitics are colliding with a global glut. So what happens to oil now? A major oil surplus is hitting the markets, the first big glut since 2020. The IEA says supply will top demand by 2.4 million barrels a day this year and nearly double that next year. The oversupply signals are now unmistakable, but war and sanctions wildcards won't let prices fall in a straight line. So how low can prices go before geopolitics push back? Muyu Xu is a senior crude oil analyst from Kepler. So the G7's plan to bar tankers from moving Russian oil raises the stakes in its standoff with Moscow at Muyu. But realistically, will it have an impact?
Right. I think the proposed G7 plans come at a time when Russian barrels are already trading well below the revised price cap. Urals is currently assessed at around $40 per barrel. And if approved, the ban is expected to curb some Russian export temporarily and squeeze Kremlin's revenue, because the seller would need to further discount their crude to cover higher freight rates required to attract the tankers willing to take on the risk. And that said, we do not expect the measures to stop oil flows. Of the roughly 1,000 tankers regularly handling Russian crude and product, about 2/3 are vessels dedicated to Russian business and largely shadow fleet tankers with Russian or opaque ownership. So banning the G7 tankers will mainly push the trade deeper into the grey market and similar to the transport of Iranian and Venezuelan oil.
Well, another risk in a peace deal between Ukraine and Russia continues to be in focus. Goldman Sachs said that they see a deal could shave $5 off oil. Is this likely, or will all hinge on the fine print?
A $5 risk of premium on flat oil prices is likely as an immediate reaction to the news. However, the policies that follow regarding Russian oil will ultimately determine where oil prices settle. A ceasefire does not imply that sanctions will be lifted immediately, and it is unclear whether the US or the EU would move fast. And if only US sanctions were lifted, Russian crude flows would largely revert to the pre-October patterns, which is most Chinese, Indian, and Turkish refiners would resume purchases. However, refiners such as Turkey's Star refineries and India's Reliance, who are still restricted under the EU's 18th sanction package, might still be unable to fully resume Russian crude buying. And if the EU were also to lift the sanctions, it remains unclear whether the European countries would actually resume buying of Russian crude, and economic incentive and political consideration would be in direct conflict, and the outcome may not emerge quickly.
Let's turn to Venezuela, and it's claiming that the real motive behind the US military buildup is oil, given its massive reserves. So would the market absorb the impact of a direct US strike?
I think it is still anyone's guess what the US ultimately intends to do. But so far, the expanded US presence in the Caribbean has not had a direct impact on Venezuelan crude export. But tighter surveillance by the neighboring countries could make it increasingly difficult for Venezuelan flows to remain under the radar. And if the US were to remove the Maduro government and a new administration pursue reform in the oil sectors, the short-term effects on Venezuelans' production and export would likely remain limited. And as seen in Syria, lifting the sanctions and bringing in the international oil company back take at least several months. And what could change more quickly, however, is that the destination of Venezuelan crude. And currently around 30% of exports go to the United States, with most of the rest flowing to China. And after a political transition or US intervention, this distribution could reverse, with Venezuelan barrels potentially redirected toward the US market.
Meanwhile, OPEC did hold production steady last month as the group treads carefully while prices are softening. Are oversupply fears growing inside the cartel?
I believe OPEC members have conducted their own assessment of market fundamentals and have adjusted their production accordingly. But unexpected events such as the drone attacks on the Iraq's Khor gas fields have also had an impact, including disruptions to the country's condensate blending into crude. And if we include OPEC plus countries, Russia's production remains constrained by the Ukrainian drone attacks and the US sanctions, and also Kazakhstan production has been reduced by the field maintenance. But that said, Our data shows that the global onshore crude inventories have reached 3.5 billion barrels, exceeding the 5-year average since mid-November, while the oil and water volumes continue to build. So this is expected to keep oil prices capped and encourage producers to adopt a more cautious stance when planning their output.
That was Mu Shu from Kepler. Don't forget, you can watch more videos on Reuters.com.